Greetings, members one and all of the Salivation Nation. Could we already be in a recession? Well, according to an economist here on this article from USA Today, we very well may already be. Let's explore. Yes, this article was sent to me by Yankee Stacking. It's something that I've talked about in prior videos, that, there's a lot of different metrics from which many people feel that once things turn into a different direction, could lead us to signs that recession is coming. But also, these are data points that we see today that could lead us to believe that. Well, as what happened in 2007 and 2008, we really didn't know by the measures of a recession, unless you're really on top of it, with the information that is provided that we see from many various different sources, until after the fact. Usually these numbers are revised downwards. But let's take a look and see what this economist says about this particular situation and see if any of this stuff makes sense and what we could possibly be heading for. And if it's not this year, will it be next year? Economists are increasingly forecasting recession next year, but one believes the downturn has already begun. And Gary Shilling, an economist and financial analyst who is credited with predicting several recessions over the past 40 years, thinks the U.S. is in a relatively mild slump. I think we're probably already in a recession, but I think it will probably be a run-of-the-mill affair, which means real GDP would decline 1.5% to 2%, not the 3.5% to 4% you had in the very serious recessions. Shilling, president of economic and financial research from A. Shilling and Company, he said in a recent interview broadcast last week by Real Vision. In such a tempered slide, he says, stocks probably wouldn't fall, but if they did, they would likely tumble around 22%, similar to other recent recessions. That, he says, would wake the Standard & Poor's 500 index, or should take the Standard & Poor's 500 index about 200 points below its Christmas Eve nadir of 2,351. His view is at odds with the vast majority of economists who expect the economy to grow a solid 2% to 2.5% this year, after expanding at about 3% clip last year and in the first quarter. Shilling points to declining industrial production, a result of the weak global economy and the Trump administration's trade war with China. And it also talks about a feeble growth of 75,000 jobs in May, along with downward revisions to prior months. And that's just it. Downward revisions and how these numbers are revisited after the fact will come into measure. And I think that once you give it a more accurate look at things after analyze the data after the fact is when we'll start to see some of this stuff play out. The Federal Reserve Bank of New York's recession probability chart, which shows about a 30% chance of a downturn in the next 12 months, up from about 10% early this year. That data are based on the inversion of the yield curve, which you've heard me talk about on this channel and others as well, which has shown rates under 3-month Treasury bonds topping 10-year notes recently, a sign that investors don't have much faith in a longer-term outlook. Inversions do herald recessions, but often 2 years in advance. The Organization for Economic Cooperation and Development's leading economic indicators, which has edged down since last year. Shilling also cites weak housing data, though he notes falling mortgage rates have bolstered home sales in recent months. Jim O'Sullivan, chief U.S. economist at High Frequency Economics, agrees that falling industrial output is worrisome, but while job growth has slowed substantially from last year, he chalks up May's 75,000 payroll advance to normal volatility. He says it's typically an outright drop in unemployment that foreshadows recession, not a slowing. One other thing I'll interject here is that, when you have a job market where basically, essentially, there's more job openings out there than bodies to fill them, by most measures, how many more jobs are you going to gain? during that period. But, I guess it just depends on the kind of jobs they are. And more significantly, Sullivan notes that initial jobless claims, a gauge of layoffs, and perhaps the most reliable real-time recession indicator, have remained near 40-year lows. So there's that. The National Bureau of Economic Research typically calls recessions based on industrial production, unemployment, retails, and personal income. And incomes have been up, actually averaging for the most part, too. Noting that only factory output is flashing red, O'Sullivan says. A realistic assessment of the evidence is that we are not currently in recession. Still, he adds, there's clearly a case for some slowing of the economy, and it won't be known definitely if the U.S. is in recession for many months. They generally don't call recessions until well after they start. And that's the takeaway from this, whether or not you agree with some of the assessments here of this particular economist. I think we can all agree that recessions typically do not reveal themselves or not called as such until months afterwards, and that's after data are analyzed and revised downwards. I think most everybody, no matter what side of the fence you're on politically or what have you, I think most of us can agree that we are overdue for recession just by the normal cycle of things. And if you take an honest outlook about how economic cycles work, notwithstanding politics or policy, normal economic activity calls for times of slower economic activity and times of booming economic activity. That can be totally independent of policy and politics, and I just feel the best way to manage that is usually the free market tends to work all that stuff out, and so that activity can grow again. It's how we recover and how we deal with recovery, I think, is one of the biggest things to consider throughout times when there are recessions and the like. How we act there and what we do policy-wise during those times, I think, makes a huge difference for the recovery, where there's real recovery. I believe in the past we've not done the right thing by quantitative easing, printing money like it's going out of style, essentially diluting the monetary supply, digitizing it, making it even worth less than it is in time, speeding up inflation, which could lead to a hyperinflation, which we've really not seen yet. Many people feel this next recession will be even worse. The author of that article believes, or the economist mentioned in that article, believes this will be a relatively mild recession. It could be, because there is real economic activity and real economic growth on top of the inflated or the artificial stimulus that was done during the earlier part of this decade. So we'll see how this all plays out. It's going to be interesting. Make no mistake, when it happens at the very beginning of its occurrence, obviously, and I think this is paramount to what it says about the recessions aren't actually called until months afterwards, gold and silver may actually go down. And obviously we're seeing that with silver. Gold is actually moving the other direction, but once it does become reality and it sets in, well, we'll see the metals react accordingly. So, given history and what it has been in the past, holding on to both gold and silver are wise moves, in my opinion. And because more than likely your silver is going to be worth something more then than it is now. How much more is anybody's guess, based off the different theories out there. Gold, I believe it's a no-brainer. It is the ultimate hedge against economic instability. So therefore, we hold on to it during these times, for sure. That's what it's for. It's an insurance policy. It's a savings account. And so that's why many of us in this community, we hold on to our precious metals, and that's why we accumulate them for times of economic hardship and trouble. And there's something to be said, too, for diversification, not only just in the metals, but any other avenues, any other ways you can find stocks, bonds, or what have you that are recession-proof, so to speak. It's a little bit of a riskier venture to go into that arena, but nonetheless, if you can find things like that, whatever it is to protect yourself, land, real estate, any other kind of investments out there. But I believe the ultimate safe haven is gold and silver. So there you have it. So post your thoughts below, and thanks again to Yankee Stacking for sending this along to me. I think this just further verifies kind of what most of us kind of understand what I've talked about on this channel before, and that is that, you know, recessions are something that are part of the normal economic cycle. And it's one of those things, really, you can't always blame politicians for. So post your thoughts below. I'd like to extend a multitude of gratitude to y'all for watching, and encourage you to please rate, share, comment, and subscribe.